going back to your chart that you talked about, starts from 1926, I actually do follow it. It's a very powerful chart to show the relative performance of all different asset classes. And the typical question that I tend to get is like, why invest in properties and why not in shares? And typically, coming from your team, my answer is that it should be diversified, balanced. So what's your take on the chart?
Well, I have another one which is a favorite because it goes back to 1900, but I don't have property data back to 1900. I've only got back to 1926. So the concept behind it is my favorite one, and it highlights the magic, as Dr. Don Stammer, who is a well-known Australian economist, used to point out to me, and I've sort of taken that on and think that's something you've got to go with. He also used to say, beware the cycle. So we all look at it and say, well, I've got to understand the magic of compound interest, and therefore I've got to invest in growth assets like shares and property. And then next time there's a cyclical downturn, lots of people want to get out. That's always strikes me as crazy. And then they miss out on the magic of compound interest. But basically what the chart shows is that assets like property, like shares, which are leveraged to the economy, benefit from economic growth, provide higher returns over longer periods of time than conservative or defensive assets like cash and bonds do. So therefore, if you want to grow your wealth, you have to have exposure to the growth assets. If alternatively, you have no risk tolerance, you don't want to hear any bad news about your investments, you're close to retirement, in retirement, you don't have a big balance, so you can't afford much up and down in the value of your investment, then sure, have your money in bank deposits getting 0.5% or whatever it is, but that because you know that the value of that capital is secure. But for those of us who want to grow our wealth and have good balances and want to continue to grow that balance, that wealth we have, then you have to focus on the growth assets. The difference between shares and property is that shares are more volatile because they're traded on the share market daily. They move up and down all over the place. And so you get that volatility there because of that regular trading, whereas the property market is not traded on the share market. It's traded in the property market, and it's a lot slower process. That has its downsides because if you want to get out, it can take you longer. We in wealth management industry call that illiquidity. So the share market is highly volatile, so it has that short-term risk up and down, whereas the property market is less volatile, but it's illiquid. You can't get it in and out as easily as you can out of the share market. So the key to me, I think, is to have a mix of both. If you want to grow your wealth over time, you want to have a well-diversified exposure to different types of growth assets. The property market will give you exposure to the real economy. It's illiquid. You can't get in and out as easily, but it's relatively stable in terms of that sort of growth you get compared to the share market. Whereas the share market will also give you good growth. In fact, over the last since 1926, they've had similar returns. And the share market will give you greater volatility, but good growth. So I think you've got to have a mix of the two. Obviously, exposure in the share market gives you exposure to industry, to business, whereas exposure to the property market gives you exposure to the property market. And both are reasonable to have exposure to. So the key to me, I think, is diversification, have a mix of both. And that, I think, is the key insight from that chart, which I think it's a fantastic chart. It's the one that I use mostly. I regularly update it, at least once a year, thankfully. The message doesn't change much, but it is something a lot of investors miss out on because they're looking at the TV or listening to the media and the prices of property have done this or the price of property have gone down, and they think, oh, gee, it goes up as much as it goes down. That's terrible. Same with the share market. Whereas anyone who has seen that chart will realise, well, the trend is up. I've just got to focus on that over the long term.
Exactly right. It's the power of compounding, isn't it? Like the earlier the person invests into for long term,
that's right.
Of course, take into account all the fundamentals in place and the risk tolerances around it, not just go and buy anything for that matter. And yes, there's illiquidity there, but just like any other thing, as in property investors get rewarded for the risk they're taking or the illiquidity premium that they have to pay on that one. So that makes sense.